Okay, I think it's time to start. Hi, everyone. It's great to see so many participants in the seminar. My name is Mattias Nordqvist. I'm professor at House of Innovation, Stockholm School of Economics. We would like to very warmly welcome the Erling Persson visiting professor Olav Sorenson to this seminar. He will be presenting a seminar about his latest research, exploring how expansion in the high-tech sector influences the broader economy of a region. And I'd like to say that this seminar is an important part of House of Innovations and Swedish House of Finance strategies to build a research environment through engagement with prominent guests and their work. And we're very happy today to have Professor Sorenson here with us. He is the Joseph Jacobs Chair in Entrepreneurial Studies, the Faculty Research Director of the Price Center for Entrepreneurship and Innovation, and a Professor of Strategy at UCLA. Professor Sorenson is one of the world's absolutely leading scholars and authorities in entrepreneurship research. And he's also recipient in 2018, I believe, of the Global Award for Entrepreneurship Research, which is the foremost award globally given to entrepreneurship researchers. And as mentioned, he is part of the Erling Persson Visiting Professor program, which we have at Stockholm School of Economics, jointly organized by Swedish House of Finance and House of Innovation. And Olav, he was supposed to be here in Stockholm this week and also next week, but due to the travel ban, unfortunate timing of the travel ban on incoming travelers, US residents to Sweden, we needed to postpone this visit until next year, where we hope you will visit us instead, Olav. But we're very grateful that Olav is still willing to give this planned seminar, even if it's digital, and also considering the time in LA. I think it's 3 a.m. at the moment, correct? Or 3:03 maybe even. Yeah. So we're very happy for that you accepted to do this. And before we start, there's a few tips for you who attend this seminar to think about before you see the slide here. Update your name, use headphones, mute your microphones, raise hand. Olav just said before that he is okay with taking questions during the presentation, but if you as participants prefer to ask your questions after the presentation, that's of course fine as well. So with that, I would like to welcome you again, Olav, and hand over to you.
Great, thank you. Yes, I had very much been hoping to be there in person this week. And I hope that I'll have the opportunity to meet all of you and talk with all of you in person, next year, I guess, probably March, if everything works out then. But I'm happy to continue to give the seminar. As Mattias said, thank you for the introduction. I'm happy to take questions sort of throughout. So if you have any questions, raise your hand. I'll also try to keep track of chat, but it's a little bit harder because I'm using a one monitor setup at the moment. So can everyone see the slides? All right. So this is a paper that I've been working on for a couple of years with Doris Guan, who is a PhD student of mine from Yale. I just moved to UCLA a year ago, so I still have quite a few PhD students at Yale. She's an exceptional student who will hopefully be on the market in a couple of years. This is her first year paper where we work on a project together with a PhD student in their first year. So, Silicon Valley is something that I think been interested in for a long time, been sort of fascinated by. And I think part of the reason that I've been interested in it is that, I was in a PhD program at Stanford in the mid 1990s, kind of right as the internet boom or bubble, depending on how you want to think about it, was starting. And, here I am, kind of pursuing a PhD in sociology. and I'm watching my friends right and left, joining internet startups, and there was this kind of mania almost about it. Anybody who wasn't joining that, at the time was almost perceived as being crazy, and kind of, it was an interesting thing to watch, and I think really stimulated a kind of long-term interest in, why do we see these kind of clusters of firms, particularly tech firms, and what are some of the consequences of those clusters? And so this is a paper sort of in that series. In terms of thinking about this paper a little bit more directly, there are kind of two things that got me interested in this question. The first is a paper that I wrote about 10 years ago. This is a paper with Sam Sasamala, was published in the Review of Economics and Statistics. And what we were interested in that paper, both of us had been teaching courses on venture capital. And one of the questions that would often come up from students was, sort of, is venture capital good for the economy as a whole? Not just for the firms that it invests in, but kind of generally, is this something that is good for society? Is it something that governments should be subsidizing? And if you look, governments around the world subsidize venture capital in different ways. Some very directly by investing in funds. Other types of subsidies are indirect. So, for example, in the U.S., taxation for the general partners in a venture capital firm is at the capital gains rate instead of at the income rate, which is a type of sort of implicit subsidy. So, I thought that this was a fairly in some sense, obvious question. So the first thing that I did was go out there and do some research. But I realized that while a lot of research had been done on the effects of venture capital on the companies that it actually funded, there was relatively little research on how venture capital affected the real economy, and particularly research that would capture sort of spillovers beyond the firms funded to other firms in the regions. So in this paper, which was really oriented at kind of an aggregate level, we were looking at, kind of what was the effect of venture capital on three different outcomes, the same types of outcomes as we're going to look at in this paper. One was entrepreneurship rates, and one of the things that we saw in entrepreneurship rates, that if we looked at venture capital, it seemed to have a positive effect of entrepreneurship. And I'll go into this a little bit more detail because this is very closely related to the methods that we're using here. But we estimated the effects in three different ways. One was we looked at essentially the cross section. So we looked at, if we compared a place like Silicon Valley that had a lot of venture capital to a place like Wichita, Kansas, which had none, and then looked at, kind of how did those economies play out over the next 10 years, what was the difference in the number of firms founded in those? And what we found is that the regions that had more venture capital had higher founding rates. So these are, in terms of the horizontal axis here, these are elasticities. Elasticities are hard to interpret because venture capital is such a small portion of the economy, but I will relate these in terms of more concrete figures in a couple of minutes. So we saw this in the cross section. We also saw this longitudinally. So if we followed a particular region, so we looked at a region like Charlotte, North Carolina, what would happen is there would be shocks within Charlotte in the supply of venture capital available there, usually because a venture capitalist raised a new fund. And so all of a sudden there would be more capital available. And so we could estimate, what were the effects of entrepreneurship within that region over time? Does it increase following the raising of these funds, or does it stay the same? So again, even within regions, using this sort of longitudinal approach, we also found there was an increase in in entrepreneurship following an increase in the supply of venture capital. And then the last approach that we used was a type of instrumental variable. In this paper, we used an instrument where we were looking at the rebalancing of funds. So a lot of, the rebalancing of limited partners. So a lot of the investors in venture capital are institutions like Yale's endowment. And they typically are operating their portfolio with some type of ideal allocation ratio. So they might want to think about having 60% of their portfolio in equities, maybe 30% in fixed income, and 10% in private equity, of which venture capital would be a part. So what happens with that type of allocation ratio is that if one asset class performs particularly well, let's say that equities do very well in a year, then in order to stay in balance, they essentially need to sell equities and buy the other asset classes, including private equity. So we essentially used the local availability or distribution of potential limited partners, so institutions with endowments, and interacted that with changes in national level portfolio returns based on data that's available from the Chronicle of Higher Education. And that provided essentially our instrument on what return or sort of what investment would look like within any particular region. Using that IV approach, we again found that there was a positive relationship between the supply of venture capital, in this case, essentially longitudinally within a region, and entrepreneurship rates in that region going forward. So that's the kind of the first finding. Another one that's kind of closely related, we looked at employment as an outcome. We found even larger effects in employment in terms of the elasticities of the effects of venture capital on employment in the region, and even larger effects in some sense on regional incomes. Now, I said that I was going to put this in terms of more concrete figures. And so, one way that you could think about the concrete figures is to think about what is the effect of one investment in a relatively typical region. So we're taking a region here that has the mean characteristics across all regions in the United States. And we're saying, given our estimates, what would be the effect of one investment? And at the time of this research, one investment meant about $1.5 million of additional venture capital within a region. So that one investment resulted in or predicted that there would be 2 to 6 new firms in the region. So that interested us a lot because it's much more than one, right? So one of your kind of in some sense your default expectation might be that if a venture capitalist is investing in a firm, at most you should be seeing sort of that one new firm. The fact that we're getting more than one means there's a couple of things that could be going on. One thing that could be going on is it could be generating a type of demonstration effect. So maybe seeing one firm get venture capital encourages other entrepreneurs to start their own firms, perhaps because they're now aware that there's more outside capital available if they need it. Another possibility, though, is that this is generated more by spillover effects. And those spillover effects could either be in firms that are related to the firm being funded by venture capital. So maybe a supplier to that firm or a distributor of that firm's products and services, or it could be spillovers just into completely other parts of the economy. So one of the things that we're going to talk about in this paper is local services. And it's possible that what we're seeing here is really spillovers to these local services. In terms of the number of jobs being created, we're seeing about 350 jobs being created per investment. That also is interesting because it's large. If we think about sort of dividing out the number of jobs by the number of firms, even if we take the higher end of that number of firms estimates, we're talking about 50 plus jobs per firm. That's a very large number, at least if we're thinking about the jobs just in respect to the firms that are being created. So the jobs number here was suggesting that at least part of the job creation happening is happening at incumbent firms, not just at the new startups that are emerging as part of this investment. And last of all, if we're sort of looking at the regional income, we're getting figures that are between kind of 30 and 113 million. It's a wide range. That's the kind of least precise of the estimates. But regardless of kind of where you pick the number there, it looks like venture capital is on average creating good jobs that are paying above average salaries in these areas. And that's true not just of the jobs directly being created by venture capital, but also in some sense in some of the spillover jobs that are being created. So, this I think was an interesting result, and we've kind of had a series of papers around this. One of the things though, that has been particularly interesting to me here is really, this question of how much of this job creation is happening within high tech and how much is happening in other parts of the economy. And so that's part of the motivation for this paper. A second motivation for this is completely different, which is one that maybe is kind of less salient for you. But if you watch the news in the United States, there have been a lot of news reports over the last few years about kind of the various problems or ills of Silicon Valley. This is a picture of a restaurant worker who's living in one of these recreational vehicles. Real estate in Silicon Valley has become so expensive that people are really going to kind of extremes to find housing. Even if they have a job, a lot of people are buying one of these recreational vehicles and then just parking it on a residential street as a place to live. Other solutions are that people have been sharing apartments with multiple other people in order to kind of afford housing in the region. And I think, sorry, one of the things this didn't. One of these stories that I found particularly interesting was this quote here, which is, I'm not sure we'll stay. The cost of doing business here are so much higher than some other place. And what's particularly interesting about this quote is not the quote itself, in a sense, because of course we recognize that the cost of doing business in Silicon Valley is high and that it's difficult for a lot of businesses to make it. What's interesting about this quote is who said it. So Charles Schwab is, one of the largest and most profitable of the online brokerages. It started as a discount brokerage, but has continued into the online space. And so here we have a fairly profitable firm in financial services, which is a relatively profitable sector. And even that firm is struggling with the cost of doing business. My brother-in-law used to work for Fidelity, and they've been facing the same issue in Boston, where they used to have all of their employees based in Boston, and the cost of rent and the salaries that they needed to pay got so high that they started systematically moving, at this point, I think about 90% of their staff to Texas, Colorado, North Carolina, lower cost areas. And so even though Fidelity is still headquartered in Boston, what's there is just a very minimal sort of headquarters staff, the top of the, sort of the organizational chart, and a few administrative support people, and that's about it. And this is, just a sample. There's lots of headlines out there that have been calling attention to the rising cost of, particularly of real estate, and the fact that even high-tech employees find it increasingly difficult to afford the cost of living in Silicon Valley. So that's kind of the background in terms of why we were interested in thinking about this. The story itself is very closely related to the Dutch disease, and that is a connection that came out of a sort of a completely different area. One of the things that I've been teaching, or that I taught for a decade while I was at Yale, was a case on the Norwegian pension fund Global. And one of the interesting discussions that we'd usually have in that case was regarding the Dutch disease, and whether or not the Norwegian pension fund was actually allowing Norway to sort of avoid some of the ills of the Dutch disease. Completely different context. Of course, the wealth in Norway is coming from oil in the North Sea rather than high tech. But we felt like there were some real parallels between the two situations. So what is the Dutch disease? For those of you who aren't familiar with this literature, this is an old literature that was really trying to understand what happened to the Dutch economy after the Dutch discovered oil or petroleum reserves in the 1950s. So what happened to the Dutch economy really mostly in the 1960s and early 70s was that they started exporting large quantities of both raw and processed petroleum products. That led to currency appreciation. So the Dutch guilder rose substantially relative to other currencies in Europe, which of course made it much harder in terms of for the manufacturing sector in the Netherlands. The manufacturers, saw a lot of their costs, things that they were importing as inputs to their production processes, of course, became cheaper. But anything that they had to source locally became more expensive. So their own labor became more expensive relative to manufacturers in other countries that had not experienced currency appreciation. And other local suppliers became more expensive relative to those outside the Netherlands. So that was one type of aspect of the Dutch disease. A second one, which is closely related, is that the volatility of the Dutch guilder also increased. Because the guilder and the value of the guilder was so closely tied to oil, the value of oil, which is a commodity. One of the things that we typically see in commodity markets is there's much more volatility as kind of supply and demand are shifting slightly out of balance, and then price is having to adjust to equilibrate. But when you have an economy that's heavily dependent on a natural resource, then the currency tends to move in connection with those commodity prices. That also causes problems if you're a manufacturer, because now there's this increased uncertainty in much of your cost structure, right? You don't know exactly how much it's going to cost you for things that are potentially bringing in from outside the Netherlands, and you don't know exactly what you might be able to charge for products that you're exporting, and so that tends to reduce investment within the manufacturing sector. At least that's what was experienced in the Netherlands during the 1960s. There's also a reallocation of particularly talent. That the petroleum industry could pay more. They were making huge profits, and so they would pay high salaries to try to attract the best people into the industry. But of course, that meant that other industries were sort of deprived of the same managerial talent. So the net effect of all of these sort of processes in the Netherlands were that manufacturing exports declined over this period. In fact, manufacturing exports declined so much that overall exports declined, because they declined more than the increase in the exports from the petroleum sector. Obviously the Netherlands has since recovered from this, but there was a fairly long period where this loss of its manufacturing base was sort of an overhang on the growth of the economy. So that's kind of the background. The interesting thing about this Dutch disease literature is that people, I think, thought the Dutch disease was something that was mostly a national level phenomenon, right? And it's easy to see why that would be true. If you think about the first two symptoms, right, currency appreciation, currency volatility, we only have fiat currency and exchange rates at the level of a country, or now sometimes even at the level of a even larger unit. If you think about like the Eurozone, it doesn't seem like something that should affect a region within a country. And likewise, some of the kind of reallocation of talent. Again, it's easy to see why that would happen at a country level, because it's there's significant barriers to people entering from other countries, but it's less clear why you wouldn't see more sort of entry into a region if a region were experiencing a boom. So the literature on this had really been thinking of the Dutch disease as a country level phenomenon. One of the things that sort of we were thinking about in this paper is that we really do think there's kind of a regional analogy to this, and we think that high tech can have some of these same types of symptoms. And I think kind of one of the reasons why is if we think about kind of fundamentally what's happening in the Dutch disease, the problem for the manufacturers is that their factor prices are increasing. Now, the factor prices are increasing there because of the exchange rates, but factor prices can increase for other reasons as well. And so what we're arguing is happening here. One of the reasons we think this is kind of interesting to look at in the high tech area is that it's clear that there has been some local cost appreciation. What's less clear in the local is to what extent this is a rise in some sense nominal costs versus real costs. So what do I mean by that? So it's possible that productivity is also rising. There's a couple of ways that productivity could be rising here. One is that we have Silicon Valley and all the best engineers and programmers move to Silicon Valley. So if we think about kind of the average quality of a worker there, the average quality might be better than other places. The other way that there could be increases in productivity is through some type of agglomeration effect. So maybe the fact that the best engineers are able to work with each other also raises the productivity of all of the people there. If this is a pure productivity effect, then this isn't really a problem, probably for the local manufacturers. Yes, they're paying more, but in exchange for that, they're getting more productivity out of each worker. So their real costs, factor costs, don't really change relative to exporters in other areas. But we think that there's reason to believe, and I'll kind of go into a little bit on this, that at least a portion of the local cost appreciation for people and for land is a rise in the real costs of these factors. The second one, I think, is one that is clearly affecting the Silicon Valley as well as kind of other tech hubs, is this massive reallocation of talent. I think I saw this already when I was a graduate student at Stanford. A lot of PhD students, regardless of what subject they had been studying, were really looking at getting into one of these internet startups. They perceived that as what to do at the time, and they were probably right. If you got into one of those startups at the right time, those people became enormously wealthy. But that, of course, meant that there was much less talent available to other industries. I think we see the same thing almost at a national level now in the United States, where if I looked at where our students went 20 years ago, the primary employers coming out of an MBA program were investment banking, consulting. People wanted the kind of plum firms that people wanted to go to were places like McKinsey, BCG, Bain, Goldman Sachs. If you look at where students want to go to now, it's the tech companies. So the top employers, the ones that everybody's trying to get into, are now Google, Facebook, Microsoft, Apple, and so forth. Which again means that there's less talent available for other tradable industries. So I want to dive in just a little bit on this idea of local cost appreciation. Now, this is not something that we're going to look at directly, but there's some interesting anecdotal evidence, at least, on what's happened to the cost of talent. So this is just an example, data from PayScale a few years ago, looking at what was the median salary for a software developer by location. And you can kind of immediately see that Silicon Valley software programmers are getting a nearly 50% premium over what most large cities in the United States are paying. Now, again, it's possible that those programmers are much more productive, but if they're not, this is a much higher cost of doing business for any company. And that this would be true not just of a software company, but these days, almost any type of company is going to need some people doing software development as a component in the products and services that they are providing. So that's one type of measure. Another one, a little bit, kind of this is a little bit different look. So that was comparing the same job title across different regions. We could also look at, well, what are some of the highest paying professions? This is occupational titles. What are the highest paying occupational titles in San Francisco and Chicago? And on average, we can see that many of these occupational titles in San Francisco are paying substantially more than Chicago. I think one of the things that really interested us in looking at this is that many of these are not, high-tech jobs, right? So if you look at, who's getting paid a lot more, with the software programmers, we could say, well, okay, we have these fantastically profitable and productive businesses that are related to software in the Bay Area. It makes sense that the programmers there might get paid more. But we're also seeing that, dentists, family doctors, financial planners, all of these, kind of ancillary services are also getting paid more in the Bay Area, and even getting, quite highly paid relative to, high-tech jobs within those areas, which we'll come back to when we get into the estimates. But I think this is a really interesting phenomenon. So that's one aspect of factor costs. We could think about the factor costs for labor. The other, which I'd alluded to earlier, and I think is, there's probably been even more press attention to, is factor costs in terms of real estate. So this is a listing that I found on Zillow a couple of years ago. This is in Palo Alto. As you can see, it doesn't look like it's in great shape, but it's a kind of old bungalow on a lot. Any guesses on what this might have listed for or gone for? Alex, can you give me a guess? $500,000. All right. Any other guesses? So Alex hasn't been to the Bay Area for a while, I think. This went for $4.9 million. You couldn't buy anything in Palo Alto for $500,000. The last time you could buy a house in Palo Alto for $500,000 was probably maybe around 1997 or 98. This is it's almost hard to imagine the kind of price appreciation that, particularly real estate markets, but obviously this has a follow-on effect to commercial real estate markets as well, just how much things have been rising in the Bay Area. So this is the Case-Shiller index for the San Francisco metropolitan area. Now, when I was in graduate school, which was 1993 to 1997, the index was a little bit below 70. I thought prices then were extremely high. That was kind of during the .com boom, and people, as their companies went public, were oftentimes buying houses and paying what at the time seemed like ridiculous prices. But in fact, those were the good old days in some sense in terms of prices. If we look at what's happened since, the index now is, on this chart is actually around 260. The incredible thing is that, as high as it is in 2019, prices in the last year have increased probably on the order of another 10 to 15%. So the index right now, I think, is sitting close to 300. So in the space of just over 20 years, we've seen an increase of 4 times, basically a quadrupling in the value of real estate. And of course, that's part of what is feeding into not just real estate costs for firms, but also what people need to pay for everything. Right, because anyone that wants to attract workers to the area knows that they need to pay them enough, so that they can afford to live there. I mean, interestingly, one of the things that's happened now in the Bay Area for like summer interns from the MBA program, so that the salaries don't seem completely outlandish, they will actually split compensation into two parts, where they will pay them a fairly normal, monthly salary. Let's say they pay them maybe, I don't know, $8,000 a month for the summer internship, but then on top of that, they'll give them like a $4,000 a month real estate stipend. So, yes, they, sort of split it into two pieces and call it two different things. But if you look at how much companies are having to pay, they're paying $12,000 a month instead of what the internships in other areas are paying, which are typically on the, kind of $6,000 to $8,000 a month range. So if we, kind of come back to, this sort of symptoms and thinking about this as an analog to the Dutch disease, the symptoms, I think, for the Silicon Valley syndrome is that, we're seeing this local, cost appreciation. This is pulling, kind of talent and capital also into the high tech sector. And what we would expect is that just as the Dutch disease led to a decline in manufacturing, here we'd expect this to lead to a decline in the non-VC portion of the tradable sector. So here we're talking about the tradable sector instead of manufacturing. One of the things that has changed since the 1960s, that if you look at the tradable sector, much more of the tradable sector now is not just manufacturing, but also tradable services. So things like consulting or accounting services, or even, this is LA, the film industry is basically a tradable service. And we would think that all of these sort of other industries would be affected, right? Their costs are going up. They're having a harder time getting access to talent in these areas. And so I think we would expect these other industries to decline in those areas. What the effect might be on the non-tradable sector. So this is local services, both at the low end, we can think about things like bars and restaurants and dry cleaners. At the high end, we can think about things like doctors and dentists and financial planners. What the effect's going to be on the non-tradable industry is less clear. And the reason why is that although it's true that their costs are also going up, they are, because they're local, they're not competing against other businesses that have lower cost structures. And so whether that actually hurts them is less clear. There's also a spending effect, right? So high-tech jobs are paying a lot of money. As those people are earning more, they're probably going to consume more in terms of restaurants and other local services. And so that may actually benefit this non-tradable sector. So that's the kind of background. Kind of shifting over, thinking about what the empirical strategy is. So there's a small literature that looks at the effects of natural resources on local economies as well as national economies. And usually the strategy in that has been to look for something that's a sort of semi-exogenous shock to the amount of resources going into those economies. In the natural resource sector, there's a couple of types of shocks that people have looked at. One is the discovery of, say, a new well. So, if you're drilling for oil or natural gas, you're experimenting, you're looking around with these wells. A lot of them don't find anything. Every once in a while, you do find something, and that's a little bit of a mini boon once you found it, because the extraction, once you found it, is quite profitable. So one strategy has been to kind of look for those types of shocks. Another strategy has been to make use of price changes. So there's a really interesting paper looking at Brazil, where they're looking at agricultural regions and then looking at essentially changes in the commodity prices for the agricultural products being produced there as a source of variation in the amount of money going into those economies. We think for the high-tech sector that venture capital is something similar in terms of providing, kind of mini shocks to local economies in the resources there. And there's a lot of variation in the United States in exactly where venture capital occurs. So this is from 2016, but it doesn't vary that much from year to year. A very large portion of venture capital is going into the Bay Area. So that's the San Francisco and San Jose metropolitan statistical areas. The third is Boston, then New York. In fact, if you did this on a per capita basis, the differences would be even larger. San Jose actually has a much smaller population than San Francisco. So on a per capita basis, San Jose is probably getting about $2 to $3 per person relative to each dollar, even in San Francisco. It's highly skewed distribution. Now, what we're actually going to look at, though, is we're looking at a period from 2003 to 2012 in this study, and a lot of these regions have had venture capital for a long time. If we think about what's going to be driving the estimates that we're looking at here, it's really going to be what places had large increases in venture capital over that decade. So I have a map that shows changes in venture capital from 2003 to 2012. The map is colored such that the blue regions are regions where there's actually a decline in venture capital over this time. Then the kind of light pink regions are places that had an increase in venture capital, but the increase in venture capital is roughly in line with what you saw overall nationally in the increase in venture capital. And then the red, and particularly the dark red places, are places that saw very large increases in venture capital. Most of the dark red places are places that prior to 2003 had little or no venture capital investment, but then actually saw a significant amount of investment in the following decade. So if we're thinking about what's going to be driving the estimates here, even though the story has been motivated by Silicon Valley, in some sense, the data, the variance that's actually driving the results is going to be coming more from places like Jacksonville, Florida, Ogden, Utah, and Syracuse, New York. Those are all regions that had little or no venture capital prior to 2003, but have been receiving, millions of venture capital. In Jacksonville's case, hundreds of millions over the decade from 2003 to 2012. So as we're gonna look at kind of three measures of venture capital when we're looking at the effects of venture capital. We're gonna look at first rounds of venture capital, total rounds, and total capital deployed. Now, these three measures essentially are differentially weighting early versus later stage venture capital. The first rounds measure, which is essentially a measure of the number of companies that have been funded in a particular region, is weighting very heavily early stage venture capital. Total rounds, you can think about as roughly equally weighting early stage venture capital and later stage venture capital. And then our measure total capital deployed in terms of number of dollars, that's very heavily weighting later stage venture capital. Why is that true? It's because the amounts are so much larger in later stage. If you looked at, like the last, I think, Series F investment in Uber, it was like a $2 billion investment. The average first round, seed round investment is about, it's probably a little bit under $2 million right now. So it would take 1,000 of those, early round investments just to equal that one later stage investment in Uber. So the total dollars deployed is very heavily weighting the later stages. For all of these measures, we're going to aggregate venture capital across 5 years. So we're going to, say how much venture capital was, deployed from 2003 to 2007. And then use that to predict 2008's outcomes. The reason that we're going to aggregate over 5 years is twofold. So one reason is that the actual venture capital dollars bounce around a lot from year to year. And because there's so much, in some sense, measurement error in that, it means that if we don't do some sort of smoothing, we're probably going to underestimate the effects just due to kind of the attenuation bias associated with errors and variables. The second reason is more substantive, and that's that in our earlier paper, we did some research trying to look at, well, how long do the, what's the sort of the time path for the effects of venture capital? And we found that venture capital appears to have effects for at least 3 to 4 years following the initial investment as companies, kind of spend those dollars. So we want to use a longer window than that. So we're capturing as much as possible, kind of not just the very short-term effects, but also the kind of medium run effects of those investments. The data that we're going to use, the venture capital data that we're using come from Venture Expert, which is a commonly used database for venture capital. The main data that we're going to use for our dependent variables comes from the quarterly census of employment and wages. This is data that's gathered every quarter by the Bureau of Labor Statistics in the United States. It is quite fine-grained data. So for every region in the country, they collect data on the number of employees, the number of businesses, and average weekly wages for nearly 1,000 different industries. And they do that on a quarterly basis. So fairly detailed data on changes in local economies. We're going to look at a period from 2003 to 2012. Those might seem like kind of an odd choice of years, but the reason why we're doing that is that MSAs, the metropolitan statistical areas in the United States, are defined or sort of redefined after every census. But it takes some time for that redefinition to be implemented. So for example, the year 2000 census was used to redefine the MSAs, and that redefinition began in 2003. Those regional definitions then are stable until 2012. In 2013, the MSAs are defined by the 2010 census. And so we're focusing on that decade because it gives us a stable regional unit over the entire period. We're going to look at 3 outcomes. Very similar outcomes to what I was showing in my opening slides. We'll look at the number of establishments as a sort of a measure of entrepreneurship or business failure, but in aggregate net. We'll look at employment. Now, the employment number here is both full-time and part-time employees. And then we'll also look at average wages. In this respect, this is different from the earlier paper. The earlier paper was looking at GDP, regional GDP, so the total wage bill for a region. Here we're looking at average wages within an industry. It's a different data set, and so slightly different information. I'm going to call this average wages, but the variable that's being collected here actually aggregates nearly all types of compensation. So this captures things like stock options, bonuses, retirement benefits as well. So it's really maybe better to think about this as kind of aggregate compensation for employees in particular industries. And one of the key distinctions that we want to keep in mind here is really thinking about, kind of what's in the tradable sector and what's in the non-tradable sector. That's a little bit more complicated than it used to be because we can't just think about manufacturing. What we're going to make use of here is a categorization that Mercedes Delgado, Michael Porter, and Scott Stern put together in 2016. They used a variety of different measures, things like whether or not this was the only region producing a good, kind of how many different regions produced a good, whether or not there was kind of exporting of the good, a lot of different statistics to try to, essentially by hand, go industry by industry and say, is this a tradable industry or is this a non-tradable industry? That's going to be the primary classification that we use here. The one thing that, you might not like about that approach is that, it really treats tradable and non-tradable as two clearly distinct categories. And particularly when you talk about tradable services, I think that becomes more problematic. There's a lot of services that are in some sense, someplace in between tradable and non-tradable, or, kind of different mixes. So think about something like accounting. It's clear that if we looked at like the big, what is it, big four now, accounting firms, that those are tradable services, right? They're, yes, they have offices in different places, but even those offices are oftentimes traveling to provide accounting services to large multinational firms. But within that same industry, there's also local bookkeepers, people who maybe even have, kind of a, they're the only person employed by, self-employed by their business. They work with many other clients, helping them prepare taxes. And those people typically have an entirely local client base, even though they're within the same industry. By comparison, there's other things that really are clearly local services. If we looked at something like gas stations, there are no gas stations that are serving customers hundreds of miles away. All gas stations have an extremely local base. And so we might actually want to be able to distinguish between businesses that, kind of are some mix of tradable and non-tradable, and businesses that are, clearly non-tradable. And so for that, we're going to use a teal index of geographic dispersion. I'm not going to present those results. It's more of a sort of a robustness test, but the results end up being, essentially the same, whether we use a continuous or categorical measure. So in terms of, just to kind of provide a sense of, what we're looking at. So what we're going to be looking at is, are places that have more venture capital more likely to, to see changes, in other parts of the tradable sector. So particular, are they going to see declines in the non-venture capital part of the tradable sector? And then we'll also look at whether or not they, how this affects their non-tradable sector, local services. So this is a graph, sort of a map that is showing what is the change in employment in the non-VC portion of the tradable sector by MSA over the 2003 to 2012 period. So areas that are in blue actually experience the net decline in the sector. Areas that are in pink experience the small net increase, something that's roughly in line with the national average increase in the tradable sector of this period. And those that are in darker red experienced higher than average growth in the non-VC tradable sector. So even just from the map, I mean, if I were to compare this side by side with the VC map, even just from the map, we're already seeing some of this effect in the raw data. So if you recall from the venture capital map, a couple of the regions that had seen the largest increases in venture capital over that decade were Ogden, Utah, and Jacksonville, Florida. And both of those regions also saw net declines in the non-VC portion of the tradable sector. Interestingly, we also see some, in some sense, in the complementary pattern, which is New Haven, Connecticut, which is where I used to live. New Haven actually experienced a net decline in venture capital over this period, and it is simultaneously one of the regions with a large increase in the tradable sector that's not relevant to venture capital. So we seem to be both seeing that venture capital is associated with decline in the non-VC tradable sector, and the lack of venture capital is associated with it potentially with an increase in the non-VC tradable sector. So that's just a kind of a illustration. What we're mainly going to be looking at here is a set of panel regressions, and just to kind of dig into what this is showing. Essentially, what we're going to be looking at is what's the effect of venture capital on 3 different groups of firms. So we can look at the effect of venture capital on the segment of the tradable sector that is funded by venture capital. And the way that we're going to identify that is we're going to consider any industry that receives more than 1% of the total funding in venture capital during this period to be a VC relevant industry. Then we're going to look at what's the effect of VC on the non-VC tradable industries. So these would be everything else in the tradable sector that received less than 1% of the venture capital dollars during this period. And then we'll also look at what's the effect of VC on the tradable industry. So these are all, in some sense, interactions between our measures of VC and these industry measures. And then we're going to have a series of fixed effects. So we'll have a set of industry fixed effects that will account for essentially the average growth in these industries over the decade. We'll have a set of regional fixed effects. I think the regional fixed effects are particularly important because those will capture things like institutional differences between regions that are relatively constant over time, cultural differences, et cetera. And then we'll have a set of year fixed effects, which will capture broad changes in the macro economy over this period. So what are the results? So let me kind of dig into the results. I'm showing these a little differently than the tables that are in the paper to try to give a little bit more of a sense of the kind of how to interpret these effects. So if we're looking at what are the effects on VC and entrepreneurship, here I should maybe make the caveat that this isn't exactly entrepreneurship. This is the number of firms that are in a region. We can start out, what's the effect of venture capital investment? And here we're focusing on the total dollar amount of venture capital on the tradable industries. So the coefficient is, 0.0122, which is an elasticity. However, because the VC accounts for such a small portion of the economy, elasticities are kind of hard to think about. I think something that's a little bit more useful to think about is a doubling, right? So what if we doubled the amount of venture capital in a region? What would the effect of that be? The effect of a doubling turns out to be a 0.8% increase in the number of firms in the sort of VC relevant portion of the tradable sector. So this would be things like software companies, semiconductor companies, also because of Uber and Lyft during this period, taxi services. And in terms of, what would that mean in terms of a number of firms, that would be an increase in the average MSA of about 48 firms in this portion of the tradable sector. One thing that's worth noting here is, I'm talking about doubling here, but because the distribution of venture capital is so skewed, moving from, say, the median level of venture capital to the 90th percentile of venture capital at a regional level involves almost 5 doublings, right? And so, in some sense, the predicted effects in moving from, kind of the average region to really an outlier region in terms of venture capital could be much larger than doubling, right? If we think about 5 doublings, then we're looking at something that's more like 4% effect, and that would mean maybe close to 250 additional firms in the VC relevant portion of the tradable sector. you know, so BC is having a positive effect on that portion of the tradable sector. That's not surprising. That's probably the least interesting of the results. If we look at what's happening in the rest of the tradable sector, so these are, you know, manufacturing businesses. These are the types of tradable services that, like consulting, the venture capital would not invest in. There, the effect is negative, right? So the coefficient is, you know, kind of a minus 0.02. That means that a doubling in venture capital is reducing the percentage of companies in that portion of the tradable sector by about 1.6%. That translates for the average MSA into 105 firms. So, you know, since both of these numbers are going to scale, what that's going to mean is that for the typical region that experiences an increase in venture capital, we're actually going to see a net decline in the number of firms in the tradable sector, right? Because they're going to lose more in the non-VC portion of the tradable sector than are gained in the VC relevant portion of the tradable sector. That brings us to the local sector. So it turns out that nearly all of the, in some sense, net business gains are really driven by the local services or the non-tradable sector. There we see a positive effect to venture capital investment. Doubling of venture capital investment is an increase in the number of local businesses by about 1.3%, which for the average MSA is translated into about 76 firms across that sector. Now that's the estimates just using the VC amount. You know, as I mentioned, we're measuring VC in potentially 3 different ways. VC amount, we could look at total investment rounds in the region, or first rounds, the number of companies that are backed by venture capital. And you know, we're seeing similar directional effects across all of these measures. But it's notable that if you look at the magnitudes of the effects, we're seeing much stronger effects from the earlier rounds than we see from the later rounds. And we think that one of the reasons that that's true, you know, we saw the same thing in the earlier paper with SAMHSA. You know, part of this, I think, just has to do with how venture capital dollars are deployed. So if you looked at, you know, most of the money that's going into a startup in its first round is being deployed locally. But if you looked at, say, what was happening in the last round of investment in Uber, you know, that $2 billion isn't being used to finance operations in San Francisco. Most of that money is going to subsidize taxi drivers around the world in the places that they're trying to expand operations. And that's going to be true of just a lot of these VC-backed businesses, is that the large amounts that you see in later rounds, a lot of that is not going to be spent locally. And so we wouldn't necessarily expect to see as strong effects locally as we do in the earlier rounds. We can also look at what are the effects on employment. So the tradable sector, again, we're seeing positive effects of venture capital dollars on VC-funded industries in terms of employment in those industries. A doubling in VC is predicting an increase of, you know, almost 1,100 jobs in the MSA. You know, again, we're seeing a negative effect, however, in the non-VC portion of the tradable sector. And, you know, interestingly, you know, there's, I think, a couple of things that are interesting here. One is to think about what's the relative size of the employment effect compared to the number of business effect. So in both cases, the employment effect is larger than the number of business effect. So for the VC relevant portion of the tradable industry, that means that not only are there more of these businesses, but that their average size is also increasing. For the non-VC portion of the tradable sector, so manufacturing and, you know, kind of other tradable services, again, the employment effect is larger than the number of businesses effect. Here, that means that not only are there fewer of these businesses, but those that survive are also contracting in terms of size. Their labor forces are shrinking. Now, if you look at the kind of the rightmost column here, that's just looking at the you know, how many jobs this would be in the average MSA, you see that it's fairly similar in size. And so in terms of employment, all of the jobs that are being created in the tradable sector in the VC relevant industries are almost completely canceled out by the jobs that are being lost in the non-VC portion of the tradable sector. There's some net job gain, but it's much smaller than the number of jobs, in the VC relevant portion of the tradable industry. So most of the net job increases in response to venture capital, again, are coming from the local sector, where we're seeing doubling, increasing the jobs in these non-tradable sector by about 1.3%, which comes to about 540 jobs. Again, if we're thinking about the relative sizes of the employment to the number of firms effects, the interesting thing in the local industry is the effect sizes are essentially identical. So what's happening is we're seeing more of these local businesses, but the average size of them is essentially staying unchanged. And then again, we can look at this across the different measures of venture capital. Once again, we see the strongest effects in the earlier rounds of venture capital for the same reasons. And then finally, we could look at average wages. This is the weakest in terms of relationship. So there seems to be some relationship between the average wages being paid in the VC relevant industries in response to an increase in venture capital. But these effect sizes are not large, right? If we look at this, we're talking about kind of less than a 1% increase in average weekly wages with a doubling in venture capital. There's also, sort of some, in some of the models, we're seeing a negative effect of venture capital on the wages paid in local services. So this is the kind of average. But one of the things that we'd been interested in, particularly when we looked at, if you recall that chart that was looking at the kind of the average salaries or the top paying occupations in Chicago and San Francisco, one of the things that was interesting there is that a lot of those top paying things were essentially occupations that are involved in local services. And so we thought it could be interesting to look at actually splitting all of these effects in terms of different segments of the local service or the non-tradable sector. We felt that there might be something very different about, a restaurant from a doctor or a dentist in terms of how these businesses might be affected by venture capital. And in fact, we do see some differences, although the differences in establishments and employment are minimal. So what we did here is we essentially divided the non-traded sector into quartiles, and we divided into quartiles according to the average weekly wages of the workers in that industry. And to avoid having the sort of the regional economy affect that classification, we're only using the average weekly wages as a national level to classify industries into the four groups. So we have a low grade wage group. This is things like, commercial restaurants, bars are in the low wage group. There's a kind of a middle low wage group. Sit down restaurants, I think, happen to be in the middle low wage group. Middle high wage. There are some services in there, including, I believe, accounting services, and the high wage group, which would be things like, doctors and dentists. There's also things like live performers. So if you're, play for an orchestra or are in an opera, you would probably be either in the mid-high wage or high wage group, depending on, which type of entertainment that is. So if we looked at, these models are just a subset of variables. We have the other variables in there as well, but here we're effectively splitting the non-tradable sector into four subsets. And what we see is the effect of venture capital, which is what the coefficients are showing, on the number of establishments is relatively similar across all of these different wage quartiles. Maybe sort of slightly larger effect in the lowest wage quartile than in some of the higher ones, but it's not a huge difference. Similarly, employment looks fairly similar across these, though there's a slightly larger effect in the high wage quartile. I should note here that these quartiles are done in terms of average weekly wages. They are not quartiles in terms of the number of people employed in these industries. There's actually more people in the low wage, more employees in the low wage quartile than in the other three quartiles combined in nearly all regions. So that means that most of the job creation that's happening in response to venture capital is actually in the lowest wage quartile here. Interestingly, however, even though the effects are sort of parallel in establishments, parallel in employment, when we look at average wages, we see some real differences, right? So in the lowest wage quartile, we're actually seeing a decline in average wages in response to investments from venture capital, at the regional level. We're seeing no, in some sense, significant differences in the middle wage categories, and then we're seeing increases in wages at the high end. So those that were already paid poorly are earning less. Those that were already paid well are earning more. One thing that I guess I would note here is that when we're thinking about interpreting particularly the low wage effect here, it's not necessarily true that the same individual is earning less money after there's a venture capital investment in the region. We think that at least part of this has to do with kind of a compositional effect. So some of the people that are employed in these low wage industries are things like managers of a restaurant, and some of those, you think about higher end employees within the low wage sector, we think are being pulled into other parts of the economy. And as they get pulled out, it leaves, kind of a less skilled group remaining in the low wage sector. And so it could be that just due to compositional reasons, you're getting this kind of decline in pay there. Rather than in some sense, a real individual level change in wages. Now, one of the things that you might worry about given all of this is that I've presented venture capital as being this kind of semi-exogenous shock to local economies, a way of thinking about shocks to the tech sector. But if venture capitalists are doing their job, you might think, well, they're accurately picking out, kind of which regions are likely to see future growth. Maybe they see an emerging technology in an area. And so what we're really seeing is some of the effects of that rather than, a shock due to VC. And so we've also estimated the models using an instrument, again, for VC. Here we're using a different instrument from what I used in the earlier paper with Samsa Samalo. Here we're using a share shift instrument, or sometimes called a Bartik style instrument. And essentially we're using national changes in the amount of venture capital available, and we're interacting that with the 2003 share of venture capital that each region had. The main effects of each of those pieces get picked up by the fixed effects. So the national changes in VC are fully absorbed by the year fixed effects. The 2003 share of VC at a regional level is fully absorbed by the region fixed effects, but this interaction term can still be used to predict the year-to-year changes in venture capital supply for each region. It turns out that it predicts that supply quite well. Depending on the model, it predicts between kind of 10 and 20% of the variation in VC at a year region level. Now, there is one potential threat, I would say, to the exclusion restriction in using this instrument, and that is that you might worry that the share of VC in 2003 is influencing kind of the future growth of a region for reasons other than change, kind of additional VC that's appearing between 2004 and 2003 and 2012. So why might that be the case? Imagine if investments in venture capitalists in sort of 2001, generate businesses that continue to have outsized large returns in a region, 5, 6, 7 years later. What we might actually be picking up in some senses the growth of those earlier VC investments rather than the effects of the later VC investments. If that's true, that should have the largest upward bias on our estimates of, I think really employment in the region. And so that's something to keep in mind. Interestingly, however, when we actually look at the effects on employment, they aren't really much larger than we see in the panel model, the naive panel models. So I'm not going to go into much detail here because in general the pattern of results using the instrument are almost identical to the pattern of the results in the fixed effects models that I went over in a lot of detail. I will point out just a couple of things here. So one is that if we look at the effect of VC on the VC portion of the tradable sector in the instrumented models in the second stage, we don't see any effect on the number of establishments in the area. We don't see any effect on income. The only effect that we're seeing is on employment. Almost all of the other estimates, however, all of the other estimates are identical in direction and are reasonably close in magnitude, usually within about 25 to 40% of the fixed effects estimates for the effect sizes. All right, so I want to leave a few minutes for questions. So let me just kind of summarize. So if we sort of think about, what is the Silicon Valley syndrome? What we think the syndrome is that this kind of booming high-tech sector leads to local cost appreciation, particularly cost appreciation in both the labor costs for the employees and also real estate costs, which then probably affect almost all other types of things that are sort of a part of the local cost structure. It also leads to kind of a reallocation of talent and capital where the booming tech sector is actually starving to some extent the rest of the tradable industry of talent and capital. And that leads to a decline in the non-VC portion of the tradable sector, a decline that in fact is large enough that the overall size of the tradable sector is not increasing very much. And then we're also seeing, increased inequality. The increased inequality is actually happening in two ways. One is that we're seeing this direct increase in inequality in the non-tradable sector. So the low wage portions of the tradable sector are earning less. The high wage portions are earning even more. In total, as you move from, say, a median to a 90th percentile of venture capital, the inequality in the non-tradable sector increases by about 25% in terms of the difference between the the high and the low wage. But we're also seeing inequality increase for another reason, which is that if we think about, what jobs are getting created, most of the jobs are getting created either in high tech, which is paying very well. The high tech firms here on average, or the high tech industries, pay about 60% more than the non-high tech portions of the tradable sector. And then in local services, most of the job creation is in the low wage quartile of the local services. So really at, kind of extreme ends of the distribution. Most of the jobs that are being lost are jobs in the non-VC portion of the tradable sector, and those are essentially middle income jobs if we look at kind of the distribution of wages within a region. So overall, we're seeing kind of increased regional inequality, and I think that this is not as pretty a map, but this really connects to some of the things that we're seeing on a national level, and that a lot of the regions that have been pointed to as kind of exemplars of economic development, like the Bay Area, and New York, and Boston, are some of the places that actually are experiencing the largest increases in within region wage inequality. So with that, I will leave about kind of 10 minutes here for questions.
Thank you very much, Olav, for an interesting and very comprehensive presentation. So let's see if we have some questions. Anyone? Roxana?
Thank you, Olav. I enjoyed your presentation a lot. You referred to many things, but one that stuck to mind is the effect on wages. And I was wondering you look for the local at low to high wages, so more salary wise. I was wondering also if it's possible to implement something based on specialization, meaning the type of complexity of the job. The second point, yes, I'm cheating, I have to, is you pointed it out, but I'm still curious if there is a way to disentangle it, if the salaries drop either because people are generally underpaid or because the best people in a certain industry will transition towards hotter industries that pay better, or they are more attractive in other ways. So are the best people just leaving, or this landscape looks the same but people are just underpaid?
Right. Yeah, I mean, I think both of those are good questions. So the disadvantage of the data that we're looking at here is that the data are essentially aggregated. They're only reported by the Bureau of Labor Statistics at a industry region quarter cell. And both of these are questions that are essentially about the individual level. So I do think there's room, and I'd like to do some research using individual level data. With respect to the first question, which really about in some sense whether some individuals maybe are benefiting from this more than others. There is a sort of a related literature in urban economics that is on this kind of skill bias, and the idea in that literature has been that it's really comparing urban to rural areas, but the idea is that highly educated people and highly skilled people earn a much larger wage premium when they move to an urban area relative to kind of a rural area. And we don't see that premium for the less educated or for people where their skills are, let's say, mostly physical skills. So the interpretation of that has been that is evidence of agglomeration economies at the city level. I think it would be really interesting. That literature hasn't really paid much attention to what industries people are working in, and I think it would be interesting to look here at the kind of connections between whether the highly educated people within, say, the VC relevant industry, or within the non-traded sector, are experiencing different wage premiums, urban wage premiums, than less educated individuals. I'm not sure. I mean, there's certainly a good reason to believe that they would. The second one, there's a little bit of, so Doris in her second year paper, so my co-author here, she used a different data set that looks at the movements of individuals with, basically what it does is it aggregates individuals into industry, region, year cells, and looks at the movements, the aggregate movements of individuals from one cell to another. So essentially she was able to study worker mobility in response to shocks in an economy. And what she found there would, at the, again, at an aggregate level, it's not an individual level, but it did look consistent with this idea that a lot of the best paid individuals in industries that were not experiencing the shock would move to the industry that was experiencing the shock, and that would almost set up like a vacancy chain. Then people from kind of a less well-paid industry would move into the jobs they had, and so forth. One of the things that she found, though, which is also, I think supports one of the assumptions here, is that 3/4 of the movement into the sort of booming industry came from individuals that were already in the region but employed in other industries. Only about 1/4 came from other regions into the sort of the region that was kind of experiencing the boom. And that's essentially a scope condition here, right? If we're thinking about, why would there be an increase in the local labor factor costs? That depends on there being restricted mobility of individuals across regions.
Probably also because of social network effects. If you want to transition to a different industry, you're more likely to know people that can help you in your local area.
I think that's right. I mean, I think the other thing that keeps people local is, friends and family. And so even if they could earn a little bit more in another region, most people have kind of a bias for staying.
Thank you, Olav.
Yeah, you're welcome.
Thank you. We have a question from Göran also. Lindqvist, would you like to?
Oh, thank you. So I was wondering, as I understood it, you studied the effect on the VC relevant traded sector as a whole. Would your data allow to study how much this investment is focused on particular industries within that sector? So in essence, the cluster effect within this sector?
Potentially. I mean, there are, I think there's about 40 industries that end up in receiving more than 1%. So there's certainly some variation there. We haven't tried looking at individual industries. One thing that we did look at as kind of a supplemental analysis was, okay, we're getting kind of decreased diversity overall in the tradable sector, in the sense that we're seeing the decline in the non-VC portion and this kind of shift over to the VC portion. But maybe we're seeing, simultaneously like an increasing diversity within the tech sector, right? Lots of different types of tech businesses. So we created a Herfindahl index of the distribution of employment within the tech sector to look at how that responded to venture capital. There, interestingly, we found that if anything, there seems to be also increasing concentration within the tech sector. So VC leads to more of that tech sector really being a small number of industries. But the size of that effect was minuscule. I mean, really tiny. So it's a little bit speculative. We haven't thought about trying to do it at the individual level, but conceivably we could.
Okay, thank you.
Yeah, you're welcome.
Thank you very much. I don't think there's another question at the moment, and it's actually 1:30 also, so we need to close the seminar. Thank you very much, Olav, for your presentation. Thanks for the great questions as well. And yeah, we will stay in touch with you until March, of course, after March also. But we hope to see you here in March. So all of you who have been attending this seminar, if you would like to meet Olav and maybe talk about your research, get some feedback, let us know. And you can contact Anders Regan and set up a meeting to talk about your research with Olav. So with
that sounds great.
Thank you. So with that, I would like to thank you all and have a nice afternoon.
Thank you. For me, a good morning.
Yeah, sorry. Good morning.
That's right. Have a
Are you
great
going
afternoon.
back? Are you going back to sleep now, Olav?
I think I might try to take a nap before the kids get up.
Okay. Okay.
All right.
Perfect. Good morning.
All right. Have a good day. I look forward to meeting many of you in person, hopefully in a few months.
Yeah.
Bye-bye.
Thank
Very
you.
much
Bye-bye.
likewise.
Bye bye, Olav, and everyone.